these are the three options right now in North Minneapolis. But in less than a week, the Aldi will close, leaving one big box store and one market on opposite sides.
For years, Aldi was seen as the unstoppable winner of the grocery world. While traditional supermarkets struggled with rising costs, Aldi thrived by doing the opposite. Smaller stores, fewer products, lower prices. That formula helped Aldi expand aggressively across the U.S. and Europe. At one point, Aldi announced plans to open hundreds of new stores, positioning itself as the fastest growing discount grocer in America. Inflation, shrinking household budgets, and price-sensitive shoppers all seemed to work in Aldi's favor. But recently, something changed. Instead of accelerating, Aldi's expansion started to slow. Store openings became more selective, timelines stretched, and behind the scenes, costs began rising in places Aldi usually controls tightly. The core of Aldi's model depends on efficiency. Limited staff, private label products, and streamlined supply chains keep prices low. But inflation hit those inputs hard. Labor costs increased, transportation costs rose, suppliers pushed back on pricing. Even discount retailers couldn't fully escape those pressures. At the same time, competition intensified. Other grocery chains started copying Aldi's tactics. More private label products, fewer SKUs, aggressive discounting. What once made Aldi unique became more common, squeezing its advantage. Aldi also faced pressure from consumers themselves. While shoppers still wanted low prices, they also expected better selection, fresher options, and more convenience. Expanding to meet those expectations risks breaking the very model that made Aldi successful. That tension sits at the center of Aldi's current challenge. Grow too fast and costs explode. Slow down too much and competitors catch up. Aldi's business model works only when costs stay tightly controlled. That control has come under pressure over the last 2 years. Labor costs across the retail sector have risen sharply. In the U.S., average hourly wages for grocery workers increased by more than 15% since 2021. For a retailer like Aldi, which relies on lean staffing per store, even small wage increases directly impact margins. Transportation costs also surged. Fuel price volatility and logistics bottlenecks raised freight expenses across the grocery supply chain. Aldi's limited SKU model reduces complexity, but it does not eliminate exposure. When suppliers face higher input costs, those increases eventually move downstream, even for discount retailers. Expansion economics became tougher as well. Building new grocery stores is no longer cheap. Construction costs in the U.S. rose by over 20% compared to pre-pandemic levels. Real estate prices and interest rates climbed simultaneously, making new store openings more capital intensive. A store model designed around thin margins becomes harder to scale when upfront costs rise this quickly. At the same time, competition narrowed the price gap. Large grocery chains expanded private label offerings and discounted aggressively to protect market share. Walmart, Kroger, and other national chains invested heavily in price matching and cost optimization. That reduced Aldi's ability to stand out purely on price. Sales data reflected this pressure. While discount grocery traffic remained strong, average basket sizes stopped growing at the pace seen during peak inflation. Shoppers came in more often but spent less per visit. For Aldi, that meant higher transaction volume without proportional revenue growth. Margin pressure followed. Private label products still offer better margins than branded goods, but ingredient costs for staples like dairy, meat, and grains remained elevated. Aldi absorbed part of those costs to maintain its low price reputation, squeezing profitability. As a result, expansion decisions became more cautious. Instead of a rapid rollout, Aldi began prioritizing store upgrades, supply chain efficiency, and selective market entry. During the peak of inflation, Aldi benefited from a clear consumer trend. Shoppers traded down aggressively. National brands lost share, and private label products surged. Discount retailers saw higher foot traffic as households focused on saving money at all costs. That trend has started to level off. Recent consumer spending data shows grocery shoppers are no longer increasing their discount purchases at the same rate. While traffic remains elevated, price sensitivity has shifted towards select items rather than entire baskets. Consumers are mixing premium and budget products instead of going fully discount. This behavior limits upside for retailers built almost entirely around private label goods. Aldi's limited assortment model, typically around 1,300 to 1,400 SKUs per store, keeps costs low but restricts flexibility. Larger competitors carry 30,000 to 40,000 SKUs, allowing them to respond faster to changing preferences. When shoppers want variety, seasonal items, or specialty products, Aldi has fewer levers to pull. Private label saturation is another issue. Industry data shows private label penetration in U.S. grocery sales rose sharply during inflation, but has since stabilized. Once that penetration plateaus, discount retailers lose a major growth driver. Aldi's core advantage depends on private label expansion continuing, not stalling. Basket data also tells a clear story. Aldi's average transaction value remains lower than full-service grocers by design, but growth in basket size has slowed. More frequent visits do not fully offset lower per-trip spending. That puts pressure on store-level productivity, especially as labor and energy costs rise, convenience has also become more important. Online ordering, curbside pickup, and delivery grew rapidly across the grocery sector. Aldi's limited digital infrastructure compared to major chains restricts its ability to capture that demand efficiently. Expanding these services adds costs that challenge its low price structure. Aldi's competitive edge has always been price. For years, its costs were structurally lower than traditional grocers, allowing it to undercut rivals consistently. That gap has narrowed. Large competitors invested heavily in price defenses during inflation. Walmart expanded its private label lines and committed billions to price rollbacks. Kroger increased promotions, loyalty pricing, and supplier renegotiations to protect share. Costco used scale and membership fees to keep grocery margins razor thin while holding customer loyalty. Industry pricing data shows that the average price gap between discount grocers and large national chains has compressed in key categories such as dairy, eggs, bread, and frozen foods. In several staple items, the difference is now measured in single-digit percentages compared to double-digit gaps a few years ago. When price differences shrink, shopper switching slows. Aldi's cost structure also faced pressure. While competitors offset costs with advertising, data analytics, and supplier scale, Aldi relies on operational simplicity. That model limits flexibility. When suppliers raised prices for raw ingredients, Aldi had fewer branded alternatives to rotate in. Absorbing costs to protect its low-price image directly reduced margins. Competition intensified further as traditional grocers copied Aldi's playbook. Store layouts were simplified. Private label penetration increased. Staffing models became leaner. The operational advantages that once differentiated Aldi became industry standard practices. Costco presents a separate challenge. While not a direct discount grocer, its pricing on bulk items competes aggressively with Aldi's value proposition. Costco's membership model allows it to operate on margins that Aldi cannot easily match without altering its structure. Market data reflects this pressure. Grocery price inflation cooled, but competitive discounting increased. In that environment, Aldi's prices are still low, but no longer uniquely low. When consumers perceive similar pricing elsewhere, convenience, selection, and digital access start to matter more. Given the pressures on costs, competition, and consumer behavior, Aldi's future expansion is shifting from aggressive rollout to controlled optimization. Instead of opening stores as fast as possible, the focus is moving toward improving returns on each location. Store-level economics are central to this change. Grocery stores operate on thin margins, often 1 to 3% operating margin. When construction costs rise by over 20%, labor costs climb double digits, and price gaps narrow, the break-even timeline for new stores extends significantly. That makes rapid expansion riskier, even for a low-cost operator. Aldi has already begun adjusting its approach. Rather than blanket expansion across new markets, the company is prioritizing regions where logistics efficiency is highest and supplier relationships are strongest. This reduces transportation costs and improves inventory turnover, both critical for maintaining margins. Investment is also shifting towards store upgrades. Remodeling existing locations, improving refrigeration efficiency, and optimizing layouts offer better returns than opening entirely new stores in expensive real estate markets. These upgrades help protect profitability without the capital intensity of new construction. Digital strategy remains a constraint. Expanding online ordering, delivery partnerships, and curbside pickup requires technology investment and labor that challenge Aldi's lean model. Unlike larger chains that can spread those costs across diversified revenue streams, Aldi must be selective about which digital services it offers and where. Competitive pressure will continue shaping decisions. As long as Walmart, Kroger, and Costco maintain aggressive pricing strategies, Aldi's expansion will depend less on being the cheapest and more on disciplined execution. Growth will come from incremental market share gains rather than rapid footprint expansion. Industry analysts increasingly view discount grocery as a mature segment rather than a high-growth one. That does not mean Aldi is in trouble. It means the phase of easy growth driven by inflation and trade-down behavior has ended.